Hi. Let's learn about what a journal is in accounting, investing, and trading. A journal is a running record of all of a business's financial transactions. It is used to reconcile accounts and is transferred to other accounting records, such as the general ledger. The journal states the date of a transaction, which accounts were affected, and the dollar amounts, usually in a double-entry bookkeeping method. For accounting purposes, a journal may be a physical record or a digital document stored as a book, a spreadsheet, or data entered into accounting software. When a transaction is made, a bookkeeper records it as a journal entry. If the expense or income affects one or more business accounts, the journal entry will detail that as well. Journaling is an essential part of objective record keeping. Journals are straightforward to review and easily transferred later in the accounting process. Journals, in addition to the general ledger, are often reviewed as part of a trade or audit process. Information that is recorded in a journal may include sales, expenses, movements of cash, inventory, and debt. The information is best recorded immediately for the sake of accuracy. An accurate journal is critical to business planning, budgeting, and tax preparation. Double-entry bookkeeping is the most common system of accounting. Every business transaction is made up of an exchange between two accounts. Thus, every journal entry is recorded with two columns. For example, if a business owner purchases $1,000 worth of inventory using cash, the bookkeeper records two transactions in a journal entry. The cash account will show a credit of $1,000, and the inventory account, which is a current asset, will show a debit of $1,000. Single-entry bookkeeping is rarely used in accounting and business. It is the most basic form of accounting and is set up like a checkbook, in that only a single account is used for each journal entry. It is a simple running total of cash inflows and cash outflows. If, for example, a business owner purchases $1,000 worth of inventory with cash, the single-entry system records a $1,000 reduction in cash, with the total ending balance below it. Separately, another line indicates that $1,000 has been deducted from the cash account. It is possible to separate income and expenses into two columns so a business can track total income and total expenses, and not just the aggregate ending balance. A journal is also used by those in the investment finance sector. For an individual investor or professional money manager, a journal is a comprehensive and detailed record of trades in the investor's accounts and can be used for tax, evaluation, and auditing purposes. Traders use journals to keep a chronicle of their trading activities and to learn from past successes and failures. Over time, a trader can sometimes spot the errors, emotional decisions, or divergence from investing strategy that caused a loss. The investor's journal typically has a record of profitable trades, unprofitable trades, watch lists, pre- and post-market records, and notes on why an investment was purchased or sold. Every entry in a business journal must contain all critical information about a transaction. In double-entry accounting, this means the date of the transaction, the amount to be credited and debited, a brief description of the transaction, and the business accounts that are affected by it. The terms are virtually interchangeable. However, the word diary implies a personal record of daily activities and events, while a journal is often used to explore thoughts and ideas in depth. Every business needs a journal. This running account of transactions is critical for recording the day-to-day activities of the business. It is used to reconcile other records and ensure that the management has an accurate and complete picture of business activities. The journal is also a key document used for purposes ranging from evaluating business successes and missteps to preparing taxes or withstanding an audit. Correction: January 30, 2023, this article was edited to reflect that in the double-entry system, transactions are recorded in terms of debits and credits, not increases and decreases. Debits do not always equate to increases, and credits do not always equate to decreases. Here are 6 key takeaways. 1. A journal is a detailed record of all transactions done by a business. 2. The information recorded in a journal is used to reconcile accounts. 3. Entries are usually recorded using a double entry method. 4. The double entry method records a transaction in 2 or more entries. Each entry identifies the account affected, and whether the account is a credit or a debit. The totals of credits and debits must be equal. 5. Single entry bookkeeping is rarely used. 6. In the investing world, a journal is a running list of trades made by an investor and why. Hope this would help. Thanks for watching.